if people can go, all right, this is volatile, stock market's volatile, crypto's volatile, housing markets can even be volatile. I'm not going to panic in a down moment. I'm going to set myself up where I'm not investing more than I can afford to lose. I'm not doing this on debt. You have to keep your income going. So whatever it is, whether it's a job or whatever, you have to be very thoughtful about that. But setting yourself up well, knowing that there's going to be a downturn, that it's about time in the market instead of timing the market.
Right.
And then you can just ride this out.
Exactly. And I think for the majority of people, the vast majority of people, that is the best advice that you can give them. Don't invest with debt. Don't invest more that you can lose. And I'm going to take it one step further, because I think for 90% of people out there, regular retail traders, investors, you don't need to be buying individual companies. Just put your money into a low-cost ETF, into a low-cost index fund, and that's it.
Facts. What are those, though?
And so,
Jaspreet, most people don't know what that means.
so let's break that down. So an ETF is an exchange-traded fund, and it is literally a group of companies, a basket of stocks. So instead of you going out and investing in, let's just say, McDonald's, the corporation, and now all your eggs are in McDonald's, meaning all of your money is in the investment in McDonald's. So if McDonald's goes up, you can make a lot of money. If McDonald's goes down, now you're going to be panicking because your whole portfolio is down. Well, the issue is you have the most upside, but also the most risk. Because if the executives at McDonald's run their company into the ground and they go bankrupt, your whole investment's gone. Now, if you invest into something like an ETF or an index fund, which are very similar to each other, now you have a group of companies where now it might be McDonald's and 499 other companies. So now what happens? You lower your risk, you lower some of your upside, but you also lower some of your downside. Because now if you run through that same scenario where the McDonald's executives run the corporation into the ground and they go bankrupt, well, you got 499 other companies in the portfolio, so you're okay. And so then what can happen in a low-cost ETF or an index fund is they have computers, and this is automated, where they will kick out McDonald's because now they're no longer fits within this 500 companies, and then they'll put in another company to take the place of McDonald's. So now it's passive on your end, because if you're not willing to put in the work to do that active investing, to do that sort of fundamental analysis, meaning listen to the earnings calls, study the revenue, study the profits, study what the corporation is doing. If you don't care about doing that, if you don't want to do that, and if you're not willing to do that, don't invest in individual companies, because now you're taking on all the risk, hoping for some upside. Versus you can mitigate a lot of that risk by just investing in ETFs or index funds, and you can do this right off of really any stock brokerage app out there, and now you can buy them. Now, how do you buy them? Well, two strategies, passively or actively. Passively, which is a great strategy, is now ideally every week or anytime you get paid, you put a little bit of money automatically into this ETF or index fund.
What system do you use for that?
So I use a platform called M1 Finance. There's
M1 Finance?
M1 Finance. There's tons of brokerages out there. You can find whatever one you want. Where now it is completely passive. Money is automatically pulled out of my checking account on Wednesdays. You pick the day, it doesn't matter. And it's automatically invested
known as dollar cost averaging.
Dollar cost averaging into my portfolio of ETFs. So I have a number of different ETFs in there. Happens every week, whether the market's up, whether the market's down, and I don't touch it. It just does its thing. The active side would be now you're looking for a good price point. And this is where it gets a little bit more advanced, where if you're willing to do the research, you can pick ETFs or index funds where if you see a big crash, you see prices go down, you can put more money in. Or now you can start looking for good companies that you believe are undervalued. But again, this now gets a little bit more advanced where you have to be willing to put that work in.
Can I ask you a really blunt and interesting question?
Yeah.
The average person, they're not financially literate. Would you rather, if they had $1,000, would you rather they play blackjack or try to actively trade that money?
Play blackjack or actively trade that money? Don't trade. I think trading, unless you want to do it to learn, I traded. I'll give you my personal experience.
I know you would trade because you know what you're doing.
Well, I wouldn't trade. I would invest.
Even you wouldn't trade. Would
I don't trade.
Your only options, blackjack, active trading.
So explain that to me, because
person.
I'm not a casino person. So blackjack is the one where you go to 21.
Oh, you're going to lose either way.
Oh, you're going to lose either way.
The reason I bring this up is I really think that the average person would be better off taking their $1,000 to Vegas and playing blackjack because it will be fun. If you try to actively trade, you're going to lose your money. Now, Is that 100% of the time? No, of course not. But Ray Dalio, for people that don't know, runs the largest hedge fund in the world. When he explains this, I'm like, oh my God, I'm never going to try to active trade. He said, you're going up against people like me. I spend whatever, $200 million a year on research.
Yeah.
And I have AI, which is making trades in milliseconds.
Right.
We know how fast the fiber optic cable is to make sure that our trades go through slightly faster than the other person, which can be the difference between, a percentage point, which could be millions of dollars. He was like, you're going to lose. And he was like, it's hard for us. And we've got whatever, 1,500 employees, like I said, AI that they've been building for the last 25 years, fiber optic cable, measuring things in milliseconds. He's like, the odds of you finding something that we haven't already traded on is basically zero.
Yeah.
Every person that I know, this is a very small sample size, I'm well aware of that. Every person that I know has lost money on a long enough timeline actively trading.
Yeah.
The only people that make money are people and I will use my language. This is how I think about myself. I am too stupid to beat the market. I'm too stupid to beat Ray Dalio. That's for sure. And Ray Dalio's entire team and AI and all that. So actively trading is off the table just because I know it would be like me trying to play professional soccer.
Right.
I'm going to get my ass handed to me by Messi. The difference between me as a footballer and Messi is the same as me as an active trader and Ray Dalio, right? The gap is so catastrophically large that at least playing blackjack, I would have a good time.
I think the difference is now differentiating active trading versus active investing.
Yes, 100%.
Because trading, I tried trading one summer in college, and I spent every day staring at charts, candles, which are these little ways that you can make a stock chart, and you get glued to the screen, you get glued to the emotion, and it is very difficult.
Yeah,
and
watching candles is emotionally addictive.
It's addicting. And so I stopped it because I realized I was never going to make any real money doing this. Active investing, what I mean by that now is you're looking at companies, and when you see this company fall because the whole world is getting scared, the whole market is tanking, well, now this is an opportunity for you to come in, buy a great company at a discounted price, and then you just hold on to it.
Now, would you do that at the company level or at the ETF index
Now,
level?
again, who is the person? For me, I would do it at the company level. For the average person, do it at the ETF level. Because, again, you have to be willing to put in the work to research companies, keep up with the earning statements if you want to buy and hold for the long term.
Are you doing active trading right now?
Not right now. But active investing. Active investing. I am not actively investing my money into the market. I'm passively investing. The reason why, for one, active investing means I'm putting my money into the market when I see a great buying point. Second thing is, if you're enjoying this video and want to take your investing to the next level, I want to remind you that I put together a free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. It's a completely free masterclass, and when you register, you'll also get access to market briefs, which is my newsletter for investors, completely free, complimentary as a bonus. So if you want to get the investing masterclass and market briefs all for free, all you have to do is click the link down in the description below to get it. It's now going into just my personal life. What is the best use for money, right? Invest my money in 5 places. My own business. I put my money into real estate, into stocks, into crypto, into physical gold. In this order. Right now, I see the most opportunity in my own business. Market briefs. And so instead of actively putting my money into the market.
Sign up now. Your favorite thing you read every morning.
It's a great newsletter, right? So it's where we break down what's happening in the financial markets into a fun, really easy to read email. But for me, I see the opportunity there. It is the biggest purpose for me.
Bet on yourself.
And the most excitement for me.
Yep.
So instead of me putting my money into the market, instead of me putting my money into real estate, which I love doing, I've been stopping these active investments and putting my money back into market briefs. That way we can build the company, build the infrastructure, build it into something bigger. And so that's
now,
where
obviously I knew
going.
the punchline, which is why I asked the question. But I want people to understand that you make a living researching this stuff, knowing about it, and even you aren't doing the active investing. You're doing passive, for sure, very wise, set that up. But for the average person, the odds that they will do better by trying to go in and saying, oh, I know where this is going well enough to know that now's a good time to buy McDonald's, whatever. They're gonna have heard headlines about Tesla and
Sure.
things like that. And I'm not saying that there aren't moments that present themselves, but like if you watch Wall Street Bets, do you watch Wall Street Bets
I
on
don't.
Reddit at all? It's scary. You get these kids committing suicide because they don't understand, like they'll do something where, I forget if it's calls or puts or whatever. I am so not good at this. I
Yeah.
want people to be, I know my limits. But whatever it is, where there's an unlimited downside,
Yeah.
and so they end up owing like $75,000 all of a sudden, and they're like, what do I do? And so now they're just absolutely devastated.
Yeah.
So anyway.
So let's put trading out the
yeah,
window.
people have to be so careful. Oh my
Don't
God.
be trading, don't trade your money. And now when you're investing in money, don't invest with debt. Don't
Yeah,
invest
so
more than you're
I
willing
want
to
to go
lose.
back to recession.
Yeah.
I think this is a huge moment of opportunity. Even though I'm warning people as vociferously as I can about trying to beat Ray Dalio, I do think that understanding that if you're playing your cards right and you're not overextended and you've done what you're talking about, you've got your 5 buckets of investment, we're going to get into, remember to hang till the end because I'm going to give you the 8 things that Jaspreet teaches a lot. But if they're doing it well, this is Black Friday for assets. And if people think of it that way, like don't get yourself in trouble, don't be overextended, don't have debt. But if you think of this as Black Friday, there's huge opportunities. And this really is a moment where I want people to pay attention and take advantage of this moment. I am so hungry for the average person to get educated on this stuff.
Yeah.
Because I have lived the American dream. And I mean, not the like it's your house and all that, but that you can change classes. I grew up lower middle class and now I'm wealthy. And so I'm like, no. This is a set of ideas. If you get your head around the right ideas, like you can really win.
Yeah.
But you have to simplify. And because of the internet, because of meme culture, people get so caught up in the emotion.
Right.
It's the one thing you can't do.
Right.
And you have to be like stone cold logical.
You have to get that emotion out. And it's hard because everywhere you look on the internet, YouTube included, there's a lot of emotion. Now I'm gonna be completely blunt, completely honest here, because I'm gonna talk about how the YouTube algorithm works, because I think we've talked about this before. I see this on my own platform where sometimes YouTube is going to promote certain video titles over the other. So let's talk about the market going down. If I say one YouTube title is the market goes down 3%, here's what you need to know. Be prepared for market crash. What's going to get more clicks?
Be prepared for market
Be prepared
crash.
for market crash. Now, I hate that because I hate these titles. Now you're going to say, Jaspreet, but you and every major YouTuber has titles that sound like this.
Oh, someone got to this video through a clickbait title.
Someone got through this, right? and so now let's dissect this, because I have a team, and for a very long time they kept saying, Jaspreet, make these types of titles, and I refused. And what happened? Views went down like this. Now, I had a heart-to-heart with a couple people on my team where they were like, Jaspreet, listen, your videos are, I'm saying what they said, I don't want to sound like a super narcissist, but they were like, your videos have real financial education that people need to hear, and it's better than what a lot of people are putting out. And I was like, okay. They're like, if this title is what it takes to get people to learn what you're saying within the video, why not make it? And so it was one of those things where I was like, oh my God, I hate this, but it's the only way to provide that financial education, to get people to click it. Because if I can get you to click that video and now I can provide you real education without saying, oh my God, I need to panic and sell. No, understand the opportunities, be calm, look for the options. That's my goal. So it's one of those things where I see it because I'm in it. And I'm gonna talk about market briefs for another second, because that's another driving reason for me wanting to create market briefs, because the internet is full of sensationalism, especially in the titles, because they need to get you to click. That's how just the internet works. It's the reality, okay? I mean, it is what it is. I have fought it for a long time. I hate it, but it's the reality. Now, the reason why I like market briefs and the reason why I'm so passionate about it is because we can completely separate ourselves from that, because now we are one email. We are, when it's coming into your inbox every day. It doesn't matter what the title is, because it's in the email. Once you open the email, everything is right there. And so now we can give you the actual news without any of that, that hypiness. And so that's the way, you and I operate. But there's a lot of people now that take it one step further, that even the news, then the actual content of the news becomes just super crazy sensationalist that doesn't make any sense. That's sometimes an outright lie, which then takes it one step further where now you have to be able to dissect the crap, dissect the good. Because the reality is if it doesn't have a quote unquote clickbaity title, you're never going to see it. It's never even going to cross your phone, your screen. It will be hidden into the depths of the internet. So now if you see it and it has a clickbaity title, the question is what's inside that content, and that's where you have to be able to dissect and dig a little bit deeper, understand if this is good and if this is not. And the general rule of thumb is that generally when times are good, they're typically not as good as the media makes it seem. And when times are bad, it's typically not as bad as the media makes it seem. It's usually somewhere in the middle. And this is where now you have to really be able to understand and do that financial education for yourself now as an investor. But the best thing is, just keep investing your money, looking for those opportunities, but then also be able to understand what's happening, which is taking some of your emotions out of the equation. And so this is now kind of, building that financial education where it's difficult to do, but it's so important, especially in this day, this age, where the internet is our means of education, where accessibility is so much more, where anybody can invest and put their money into the markets. Anybody has access to these tools. Like, one thing that I want to mention is when we talk about building wealth, whether we're in a recession or not a recession, the majority of people, I think, assume that it's a lack of tool set that's stopping them from getting to where they want to go, when in reality, for the majority of people, it's a lack of mindset. Most of us have access to the tool set. It's just our mindset that's lacking. You don't need a ton of money.
What's the mindset problem?
The mindset is one, believing I don't have enough money. I don't have access to enough tools. I don't have access to enough things to go and do it. That if I want to go and build a business, I need this, and this. I need $10,000. I need $100,000 to go out and do that. I need to have this type of degree. I need to have this type of parent. I need to have access to these types of people in order to go out and build a successful business. If I want to go out and invest my money, I need $10,000 before I can invest for it to be worthwhile. Why would I want to start investing with $10? What is that going to do? When in reality, these small investments do build up. If you are 21 years old today, and you start by investing just $100 a month, which is just over $3 a day. And you do this consistently until you retire, until you're 65 years old, 66 years old. And you can get an average 10% return on your money. That doesn't mean it's a 10% return every single year. It's an average 10% return over the course of investment, which is the average stock market return. You will retire a millionaire on that $100 investment, assuming you never increase the amount of money you're investing. And we're talking about less than $4 a day.
Whoa. That's $100 a month, not a one-time $100.
$100 a month.
Yeah.
Less than $4 a day. You put $100 a month for the rest of your
40
life.
years.
And so even if you get a raise and you never put another penny into your investments, you will be able to retire a millionaire on the $4 a day that you're putting aside.
Yeah, see, that's why I want people to get stoked on that. Like, look, there is an entrepreneurial side, and we can talk about that later. That's exciting and high risk, and pour yourself into it. You will get kicked in the face over and over and over. But if you care about the thing that you're doing and you have a strong enough why, even losing can be incredibly fulfilling. But that's a separate bucket. When it comes to investing and thinking about retirement, it is a totally different ballgame.
Right.
It really does boil down to buy low and sell high. Now, how do you get to that point? You can do what you just talked about, which is you put a little bit of money in, doing dollar cost averaging, and you may be dollar cost averaging simply because you don't have the capital saved up to do it any other way.
Right.
By the way, capital is just a fancy word for money. So you don't have the money saved up to do it any other way. So you're just, every paycheck, it's pulling out, you say you do it on Wednesdays, whatever. Just at some increment, it's pulling some amount of money, which can be very small, to your point, $100 a month. But doing it consistently and not selling in moments where everybody else is freaking out. And then, like, as advanced as you need to get is, if we're in a downturn and you're doing your ETF or your index, and you know that we're in the middle of a difficult time, maybe instead of $100 that month, it's $150 or $200, right?
Yeah.
You're not going crazy, you're still just dollar cost averaging, but now you know that when it's Black Friday for assets, that you're gonna spend a little bit more just because you know it's gonna go farther.
Exactly.
But it isn't sexy, man. And this is why, like, having now witnessed euphoria, I'm like, people act a fool. And I had the impulse to act a fool. I was like, no, go more. You're so smart. Like, you get this. This isn't. And I was like, I know better than that.
Yeah.
I am a fool. The only thing I can hope for is that by staying rational and calm and not overextending, that I can stay in this long enough to sort of wash out my ignorance.
Exactly.
Just through time.
Exactly. I think it was Wall Street Journal that used to do this thing back in the day where they used to bet against a monkey, where a monkey would throw darts at a stock.
I love this already.
And they would compare what the monkey picked against traders.
This really happened?
This really happened. Look it up on Google. And so the monkey obviously had no financial education. It just literally threw darts at these companies. It would hold on to it. But I think it was a 10-year span, or it was a long-term thing. Compared it against these massive traders. Guess who won? Not the traders, the monkey.
Oh my God.
And it just shows.
Can we turn that into a T-shirt? That feels like a T-shirt. This is so hilarious.
It's reality.
But it's really important for people to understand. A monkey outperformed professional traders.
Professional traders.
I'm gonna have to look this up.
Look
this
it up.
is way too important.
This is the reality where it's just the value of owning an investment for the long term. And it, like you said, that short richness is loud. It's flashy. Everyone talks about, oh my God, I doubled my money in this meme stock. Oh my God, I made so much money here. It's loud and it's flashy, but that's also fleeting. It's the
It's
first to
also
come,
how
the
you
fast to go.
lose money. Where it's like, yeah, you gained all that money, but then you lost it all.
Exactly. But the real wealth, real, true, sustainable wealth is built in silence. It's quiet because it just keeps happening in slow increments over time. And now you start to build this, there's that snowball analogy where I'm from Michigan, right? We have snow there. You start by building a small snowball like this, you put it on the ground and you start rolling it. In the beginning, you got to roll it a lot because you have this much surface area to pick up as much snow as you can. As it gets bigger, it grows faster because now you have all this surface area that can pick up more snow. So you roll it and it picks up more snow and gets faster and bigger and faster and bigger and faster and bigger. And before you know it, now you can have a massive pile of snow. But the initial one is the hardest because you're starting with $100. And you're like, what's $100 going to do? But if you stay consistent with the $100, and if you make more money, you keep putting more money in, and you just stay consistent, letting the $100 grow. Then you put in another $100. Now the first $100 is growing, and then you add in another $100, and then you add in another $100. Now the first $100 has grown, hopefully. The second $100 has grown, hopefully. Now you add in another $100 to grow, and you just keep doing that, month after month after month after month. Now you're really starting to build a snowball that's growing and growing, and if you look at this not month after month, but year over year, that's when you really start to see the returns. But the problem is, who wants to wait that long? Nobody wants to wait 10 years, 20 years, 30 years, because we're thinking about, when can I buy my Lamborghini tomorrow? How can I buy my Lamborghini next year? How can I have the nice stuff now? And this then becomes a different question. We're turning to these long-term investment vehicles to make us rich next month, as opposed to actually doing what it's supposed to do, which is make us rich over the long term. We're trying to do it the wrong way. So now we got to flip the question. If these types of investments are there to make us rich for the long term, how can we make more money today? And so this is where people turn to things like trading. Oh, I can flip these stocks, I can flip these houses, I can do whatever to try to make a lot of money right now. And for some, it might work in the short term, but it is very difficult over the long term. And this goes back to what you were saying regarding something like entrepreneurship. This is more of an income issue because now we're trying to create an income through trading. Now, if you are a full-time trader, you have the systems, you have the tools, this is all you do, maybe it works for you. But for the vast majority of regular people, it is not going to work. And this is where now something like, just like entrepreneurship, it's not going to work for the majority of people. Majority of people are not meant to be entrepreneurs, but you have to start asking the question of, how can you increase your income if you want to have that better lifestyle? But now, I want to caution that a little bit more too, because we talked in our previous interview about building systems, how to become financially smart. This is where now one of the simplest, not easiest, but simplest ways to become wealthier faster is when you increase your income to not increase your expenses. And so the best way for me to give an example of this is if you ask the majority of people, what's caused your financial issues? The majority of people are going to say it's an income problem. If I just made an extra $10,000, I'd be able to put money aside for my investments. I'll be able to do this. I'll be able to do that. I'll be able to do so many other things. But what data has showed us is for the vast majority of these people is when you make that extra money, what happens? Your expenses go up right with your income. Now you got to buy a new car that matches your new income. You got to go on a vacation. You got to celebrate. You got to go out. You got to live this lifestyle that matches your income. So instead of doing that, create a system that flows no matter how much money you're making. And one of the simplest things that you can do is follow something like a 75-15-10 plan, which means that for every dollar that you earn from now on, 75 cents is the maximum you can spend. 15 cents is the minimum that you're investing, putting aside for investments. 10 cents is the minimum that you're putting aside for your savings. So now whether you're making 40 grand a year or $4 million a year, it doesn't matter. You're still following the same system.